Is it time to prepare for another lost decade? Every time I hop on the financial news, it's nothing but terrible news, and this continues to happen over and over. Actually, I want to share with you, I was just taking a look at the lost decade because somebody commented on one of my videos. They were asking, hey, what about the lost decade? Stop saying 10% returns. 10% returns aren't real. You need to consider that you might get 0% returns. And they're not wrong, but they are wrong. And I want to show you why I'm not worried about this. But just go into the news, take a look. Bank of America says growth stocks are in a bubble, exceeding the dot-com and Nifty 50s era, warns they could take the S&P 500 down 40%, right? The stock market is going to crash. Everything is overvalued, blah, blah, blah. Vanguard, one of the most famous and reasonable companies out there. It's where I have most of my retirement accounts. They're saying U.S. equities, basically the S&P 500, is only going to return 3 to 5%. Probably about inflation. So basically an effective 0% return for investors. And in fact, bonds are going to outperform over the next 10 years. And I see stuff like this and I see people panicking and saying, you're going to get terrible return, like stop saying 10% returns. But then I look at the actual data and we've been through way worse stuff than this, including higher inflation, worse world issues, global events, and we still get 10% returns. And I'll show you that here in a second. But I want to go even further down this. So I was like, okay, companies like Vanguard and Bank of America and Chase, everybody's predicting, oh, the stock market's overvalued. And maybe it currently is. But then I go back and go, okay, well, if they've said this in the past, how has that turned out? So I found there was a Vanguard, I think it was from 2017, where they're saying Vanguard's telling investors to expect medium-term returns anywhere from 4 to 6%, a more cautious outlook. Things are going to go poorly. Things are things have been overvalued since the year 2000. And yes, there was a big correction back then, but everybody's just saying the sky's not falling, but the market outlook is dimmed. And there's a high risk because there's these overvalued companies. And I'm not going to get into the details of what that is or why that is. But basically, they're saying we're going to get 46% returns. So I go, okay. Since 2017, Vanguard made this prediction. 4 to 6 seems reasonable. That's about what the stock market is going to return. But since 2017, we had an interest rate hike in 2018 that actually tanked the markets a little bit. And then we had the 2020 pandemic. And then we had massive interest rate hikes and all kinds of turmoil in 2022. And then we had the global tariff catastrophe of 2025. Let's see how the markets have done since all of that stuff. Sounds like Vanguard might be right here. Poor returns. If you put 10,000 in back in 2017 and let it sit, oh no, you've gotten 14% returns per year in the S&P 500, and your 10 grand would be over 30 at this point. So through all of those terrible global events, we've actually exceeded and gotten 14% returns. Now, does that mean we're going to get 14% returns going forward? No. It might mean that we actually get lower returns for the next 5-10 years to sort of even out. But long term, the S&P 500 continues to perform. You're investing in the top 500 companies in the United States with market caps, huge innovation. 10 plus million people go to work every single day at these companies to make you wealthy as an investor. So when I see people freak out and go, stop saying you're going to get great returns and you need to be, so bearish and think that everything's going to be terrible. It's fine to be conservative, but don't be conservative to the point where you work longer than you have to. Like, that's my biggest thing, is that people expect very poor stock market returns for the next 10 years. I say I don't care. In fact, if we walk into another lost decade, I actually don't care. Now, if you're going to be retiring in the next 10 years, you are going to have a different investment approach. Don't go all in on equities. Don't put everything in the S&P 500. But if you have a long-term growth mindset and you know you're going to be investing for a very long time, and I'm speaking to you, people in their late 20s, early 30s, even up to age 40, you have a 20-plus year time frame of investing before you get to retirement. Don't freak out about the lost decade. And what is the lost decade, you might be wondering? So what the lost decade is basically between 2000, during the dot-com boom, when everything was a dot-com company, even though it actually wasn't. And then there was the bubble popped, and there was a ton of leverage to trading, and everything was overvalued. And then what happened was between 2000 and 2010, you had this huge sell-off and massive drop in the market. In 2000 to 2001, stocks lost half their value. The NASDAQ went over 70% down. The NASDAQ is sort of those top growth companies. Whew, massive bubble pop. People lost a ton of money because they sold at the wrong time. But then as the stock market started to recover, we had a huge real estate bubble in 2007 and 2008. And it was honestly a lending crisis, and there was a lot of shady stuff that banks did. But then we had the huge Great Recession in 2008, 2009, another massive market crash, 50% sell-off. So if you invested $10,000 in 2000 and just let it sit there from 2000 to 2010, your $10,000 would be worth $10,900. 10 years of investing would be worth basically the same amount 10 years later. And again, due to inflation, you actually lost money. You can see here, cumulatively, you lost 1% a year. So you invested in the S&P 500 expecting returns over 10 years. You basically made nothing per year. And so when people say you need to watch out for the lost decade, this is what they're talking about. They're saying, hey, you can't tell people they're going to get 10% returns. Look at the lost decade. And I get it. Like, that 10-year period was rough. It was a very difficult time for investors. Now, again, if you are entering into retirement, you are relying on your investment income. You're not putting 100% of your money into this thing. You would have fixed income assets. You might even have a couple years of cash saved up in a high yield savings account, and then you got medium-term bonds, and then maybe 50% of your portfolio was in this. And you can ride that wave down and back up. And through rebalancing, you can pull money out of the correct places without destroying your retirement. But if you're younger, you might look at this and go, I don't want to deal with that. I don't want to invest for 10 years and get zero return. You won't. And here's why. It's something called dollar cost averaging. And the idea of dollar cost averaging is you put money every paycheck, every single month, and you're purchasing stocks. And the thing is you're purchasing stocks during all of this. So the S&P 500, your $10,000 goes in, then goes back down, then back up, and then back down. But if you're looking at the actual chart of the S&P 500, you're buying stocks when the valuation drops, right? It dropped 50%. Now you're buying stocks for half off. Every single paycheck, every single month, you're buying stocks for half off. And as it recovers, you're buying on the way back up. And then it drops again, and you're buying stocks for half off again and back up. This is called dollar cost averaging. You're making purchases all along the entire way. So then your average cost for a share of the S&P 500 is actually lower, right? It actually brings your average cost for those shares down, which means you're going to get more money. And the best calculator that I found to show the power and impact of this is on the Of Dollars and Data, Nick's website here. So you got an S&P 500 DCA, meaning dollar cost averaging calculator. You can put in your dates. And so we'll say January of 2000 to 2010, to December of 2010, right? Top to bottom, this is the lost decade. You would have made basically no money. And so if you have that 10,000 in, let's say there's no investments here. You calculate, as you can see, very similar, right? We had month dates in here, so it's slightly different. But basically, you've made no money. That $10,000 has gone nowhere, and effectively, due to inflation, you've actually lost money. But if you kept investing during that time, let's say there's a lost decade, and you're not going to get great returns for the next 10 years, but you continued investing $500 a month. Check this out. Now, it's not going to be 10% returns, but it's not going to be zero, right? It's not going to be 0.52. You're actually going to get a little bit more. So now, with your dividends reinvested, you're getting about $90,000 versus before you were at $10,000 because you did nothing, right? But if you put in $500 a month, now all of a sudden you're getting something. Not great, but it's something. Now, here's the key. You don't stop investing here. This is why 10% returns work, because you're not looking at a 10-year time horizon. If you are investing for retirement and you're looking at a 10-year time horizon, you are doing it wrong. You can't expect 10% returns over a 10-year time horizon. You should have a different asset allocation. You should be investing differently. You should be stair-stepping your way into a more conservative portfolio so that you are protected going into retirement. But if you continued investing, right, things went very poorly and very poorly again, but you kept investing, right? You put in $75,000 or 65,500 plus the 10,000 you already had in the market in the year 2000. But you kept investing all the way to today. So let's say we're in August of 2025. Okay, well, let's go to July because we don't have all of August's data yet. Boom. 10.65% returns. You put in 163 grand and now you have $860,000. Here's the key. Here's the whole thing about this lost decade. Everybody freak out. You shouldn't be investing in the S&P 500 and you can't expect 10% return, all that stuff. You only lose money if you stop investing, and you only lose money if you sell. Say it again. You only lose money if you stop investing, and in fact, you don't lose, it just sits there. And you only lose money if you sell. You need to be a robot when you are investing. You are going to go through massive market crashes. We saw a 35% drop within like a week in 2020. If you have 6 figures invested, that doesn't feel good, right? You lose 35 grand in a week, that doesn't feel good. But if you continue to invest on the way down and the way back up, you were far beyond where you were before. In fact, a lost decade is an opportunity for the long-term investor. It is an opportunity to purchase at a cheaper price than they would otherwise be if it just kept going up and to the right the entire time. So if you're investing for 20, 25, 30 plus years, then you don't have to worry about the lost decade. Because there's always opportunity. If you can find a way to continue to invest every single month, every single paycheck, you will be okay. The market always recovers. If we just look at the S&P 500, right? Let's look at S&P 500 100-year chart. Here we go. So over the last 100 years, here's what you're looking at. It just keeps going. Now, these blips don't feel good, right? Here's 2000, whoop, went down. 2008, whoop, went back down, right? You were basically flat for 10 to 12 years here. But if you invested, now your average price is way down here, but the value of your investments is way up here. So if you continue to dollar cost average into the market, you're going to win. You're investing in the top 500 companies in the United States. You're investing in the Teslas and the Apples and the Nvidias and the Microsofts and all the massive companies that employ hundreds of millions of people that get up at 6 a.m. every single day and go to work to crush it, to innovate, to create solutions to the world's problems. And when you do that, you are now putting your money to work to grow along with those people. So you've got 100 million people going to work alongside your dollars to make you wealthy. That's what it means to be an investor. If you can't handle the volatility, then you can park your money in bonds or in a high yield savings account and earn 4%. But you're not going to get anywhere near the 8 to 10% returns and the massive wealth building opportunity unless you put your money in the market and risk seeing your money go up and down. But if you don't panic sell, if you don't make emotional decisions about your asset allocation, if you have a proper plan in place, that's how you build wealth, period. So the lost decade, I'm not saying I welcome it because I don't want anyone to have to go through job loss or any type of crisis that would cause the market to crash. That's not fun at all. It's not fun for anybody. I lost my house growing up during the dot-com bust and during the 9/11. There was such a massive market correction in 2000, 2002. We lost our house. We lost vehicles. It was not fun. We had to go rent. It was a very difficult time. I didn't even understand what was going on. I was a teenager. But that presents opportunity for the people that have the ability to work through it, to continue to invest, and become long-term investors. And if you can know that there will be a regression back to the mean, and the average has been, 10, it's actually been closer to 11.5%-ish over the last 100 plus years. And even if you're looking at a 40-year time period, it's closer to 12%. I'm not saying that's exactly what it's going to be. That's why I used 10%. But don't say, I'm sorry, you get 6% returns for the rest of your life. For the next 50 years, while you're working and then while you're retired, you're going to get that's just that's so pessimistic that it's never going to give you hope, and it's never going to give you an end goal. And you can never plan for retirement if you're thinking in those terms. You need to know what you're investing in. You got to be confident in it, but don't overcorrect the other way. Don't panic, sell. Don't be too conservative. Like, allow your money to grow. Put it to work. Let it be part of the volatility of what it is to be inside the U.S. economy. But if you have the fortitude to stick it out and just continue investing for the long term, you could get those 10% returns. History continues to prove that. And in fact, I've gotten more than that because I really started heavily investing in 2008, 2009, and I just kept going through that. So my average returns over the last 15 years have been closer to 13%, just because I've dollar cost average invested. That's just what it is. I'm not saying that's what you can expect. To me, 10% is pretty spot on. So I hope that was helpful in sort of like realizing that the lost decade isn't lost. In fact, it's an opportunity for the people that have the right investment plan. So if that was helpful, let me know below. I would love to hear from people that have actually gone through that lost decade and were investing, maybe people a little bit older than me that had invested, through the 1990s all the way up through 2010 and kept going. Or maybe there's some stories where it didn't go so well. I know some people that sold at the bottom in 2009 and there was a tax hit. They had to cash out their 401k. It was really stacks of poor decision making that put them back decades worth of savings and investing. So it can go very poorly if you don't have the conviction to continue investing. But anyway, drop comments. I want to talk about this because I see it pop up in my comments all the time when I talk about my Coast Fire journey and my expected returns and when I run my retirement calculations and all that stuff. And people get very upset in the comments that I say 10% returns is something that the market has averaged. And they cherry pick dates like the lost decade and some other things. And I get it. It's something that needs to be considered. But I would love to know what your thoughts are. So just drop a comment below. And I'm going to be dropping videos every week. I'm super passionate about this stuff. I'm deep into Bill Bengen's new book, by the way, Why the 4% Rule is Going Away. And he's updated it to basically the 5 to 7% rule. I made a whole video on that. I'll link that up here. But I'm going to be dropping videos. So love for you to join the journey. Subscribe if you're interested in this stuff. Or even if you just want to hate comment at me, drop it below. Let's have a chat. I care about this stuff, and I hope you do well. All right. Talk soon.